What if I told you that the smartest move in one of the most volatile market environments in decades was to do nothing? No trade, no bold bet, no heroic conviction, just patience. While the world rushed in the opposite direction, markets were loud, headlines were confident, valuations felt justified. And yet, beneath the noise, something far more dangerous was building: certainty without clarity. Capital was being deployed faster than risk was being understood. Everyone wanted to be early, few wanted to be right. And here's the uncomfortable truth: the greatest losses don't come from being wrong once. They come from refusing to slow down when the environment is quietly screaming at you to pause. Because in markets like these, speed is seductive, but discipline is decisive. Stay with me, because by the end of this, you will understand why sometimes the most powerful position in the market isn't being invested. It's being ready. When you spend enough time in markets, one truth becomes unavoidable. Humility is not optional, it's compulsory. Markets have a way of reminding even the most confident participants that certainty is often an illusion created by good times. Looking back at recent conditions, with the benefit of hindsight and hard data, it's fair to say that holding cash would likely have been the more intelligent decision. Not because opportunity disappeared, but because risk was being consistently underpriced while volatility was being politely ignored. For years, investors have been trained to believe that capital must always be working, always deployed, always chasing returns. Cash was treated as lazy, inefficient, almost irresponsible. But markets don't reward ideology, they reward accuracy. And when asset prices begin to reflect optimism rather than fundamentals, discipline matters more than activity. In environments where inflation pressures collide with aggressive monetary policy, where geopolitical uncertainty reshapes supply chains overnight, and where valuation multiples stretch beyond historical logic, the smartest position can be the one that preserves flexibility. This isn't about fear, it's about respect. Respect for the complexity of global markets and the limits of forecasting. The idea that every environment demands aggression is flawed. Sometimes the highest return decision is survival with dry powder intact. Cash, in moments like these, isn't surrender. It's leverage deferred. It gives you the ability to act decisively when others are forced to react defensively. Markets over the last cycle delivered a clear message. Volatility was not an anomaly, it was the feature. Rapid policy shifts, unexpected economic resilience followed by sudden fragility, and crowded trades built on consensus narratives created conditions where patience outperformed prediction. In that context, capital preservation wasn't a missed opportunity, it was a strategic advantage. There's also a deeper lesson here, one that goes beyond portfolio construction. Great decision-making requires the willingness to admit when conditions have changed. Not every cycle rewards boldness. Some reward restraint, and the hardest skill in finance is not identifying opportunity, but resisting the pressure to act when the odds are unclear. Ego pushes action. Discipline allows waiting. Holding cash during uncertain periods is an acknowledgement that timing matters just as much as conviction. You don't get paid for being early when volatility punishes impatience. You get paid for being right when the environment finally aligns with reality. That alignment doesn't announce itself. It reveals itself slowly, often after weaker hands have been shaken out. If there's one takeaway, it's this: humility is a competitive edge. Markets don't punish intelligence, they punish arrogance. And the ability to look back and say, we could have been more patient, isn't weakness, it's wisdom earned. Cash didn't outperform because it generated returns. It outperformed because it preserved choice. And in markets defined by uncertainty, choice is the most valuable asset of all. Volatility has a way of stripping markets down to their essentials. It removes comfort, exposes weak assumptions, and forces participants to confront what they truly understand versus what they merely hoped would continue. When volatility rises, it isn't chaos for the sake of chaos, it's information. And the investors who learn to listen instead of react are the ones who come out stronger on the other side. Over the past period, markets have moved with speed and force that challenged even well-constructed strategies. Interest rate expectations shifted rapidly. Inflation narratives changed mid-sentence. Political and geopolitical developments rewrote economic forecasts overnight. In that environment, price action wasn't just about fundamentals. It was about positioning, crowd behavior, and fear moving faster than analysis. Volatility became the dominant signal, and ignoring it came at a cost. What volatility teaches first and foremost is that risk is never static. Models are built on assumptions, but markets are built on behavior. When volatility expands, correlations that once felt reliable begin to break down. Assets that were supposed to hedge each other suddenly move in the same direction. Liquidity thins, spreads widen, and decisions that looked prudent in calm conditions become liabilities when the pace accelerates. This is where discipline matters. Volatility doesn't demand constant action. It demands clarity, the instinct to trade every movement, to chase stability in crowded safe positions, or to force capital into uncertain setups, often does more damage than patience ever could. Volatility punishes emotional decision-making. It rewards those who maintain balance, who understand that not every move needs to be captured and not every storm needs to be navigated head-on. There's a misconception that successful investing is about predicting volatility. It isn't. Volatility is inevitable. The real skill lies in preparing for it, structurally, psychologically, and strategically. That means building portfolios and strategies that can absorb shocks without forcing reactive decisions. It means recognizing when the environment itself is the risk, not any single asset. Volatility also reinforces the value of optionality. When markets are calm, optionality feels expensive. When markets are turbulent, it becomes priceless. Having the flexibility to wait, to reassess, and to deploy capital when pricing reflects reality rather than hope is a competitive advantage. Volatility creates opportunity, but only for those who aren't already overcommitted when it arrives. Perhaps the most important lesson volatility teaches is humility. No one controls the market. No strategy is immune, and confidence without adaptability is fragile. Volatile markets remind us that strength isn't measured by how aggressively we act, but by how well we manage uncertainty. The goal isn't to eliminate volatility. That's impossible. The goal is to respect it, learn from it, and use it as a guide rather than an enemy. In the end, volatility is not the villain of investing. Complacency is. Volatility forces accountability. It reveals whether decisions were grounded in discipline or driven by momentum. And for those willing to listen, it offers a clear message. The market is always teaching. The question is whether you're paying attention. There's a misunderstanding in markets that choosing caution means choosing weakness. That stepping back, holding capital, or slowing deployment is somehow an admission of defeat. That mindset is not wrong. It's dangerous. Defense, when done thoughtfully, is not retreat. It's preparation. And preparation is what separates those who endure from those who disappear when conditions turn. Capital is a finite resource. Once it's deployed poorly, it doesn't simply reset. Losses compound, opportunity shrinks, and decision-making becomes reactive. In uncertain environments, the first objective is not to win. It's to remain in a position where winning is still possible. That's what disciplined defense provides. It preserves flexibility. It protects the ability to act decisively when clarity returns. Markets don't move in straight lines. They lurch, they overshoot, they correct violently. And in those moments, investors who are fully committed, fully leveraged, and fully convinced often find themselves with no room to maneuver. Defense isn't about predicting the next move. It's about ensuring that no single move can take you out of the game. The paradox is that defense often creates the best offense. By maintaining liquidity and reducing forced exposure, you gain something incredibly valuable: time. Time to analyze rather than react. Time to distinguish between real opportunity and false stability. Time to wait for pricing that reflects risk honestly instead of optimistically. That's not passivity, that's strategic patience. Crowded trades are a perfect example of why this matters. When fear enters the market, investors rush toward the same perceived safety. What they find instead is congestion. Liquidity vanishes, exits narrow, and losses accelerate. Defensive positioning isn't about hiding in the same places as everyone else. It's about avoiding the need to hide at all. It's about structuring exposure so that volatility doesn't force your hand. True defense also requires intellectual honesty. It means admitting when conditions don't reward aggression. It means resisting narratives that encourage constant action for the sake of appearances. Markets don't care how busy you are. They care how accurate you are. And accuracy improves when emotion is reduced and optionality is preserved. There's also a leadership element to defense. Whether you're managing capital, building strategies, or guiding teams, calm decision-making under pressure sets the tone. Panic is contagious, but so is discipline. When uncertainty rises, people look for stability, not bravado. Strong defense provides that stability. In the end, defense and opportunity are not opposites, they're sequential. You defend first so you can attack later on your terms, with better information and better pricing. The investors who last aren't the ones who swing at every pitch. They're the ones who know when to wait and when to act with conviction. Defense isn't weakness. It's respect for the market, and markets reward respect far more consistently than they reward confidence alone. Every organization, every investment platform, every serious participant in markets builds a culture around one central belief that value can be found, analyzed, and captured. That belief fuels ambition, it drives innovation, it creates momentum. But culture, no matter how strong, cannot override reality. And one of the most important lessons markets teach is that conviction must always remain adaptable. In ideal conditions, a culture of relentless engagement works. You search for inefficiencies, you allocate capital, you lean into opportunity. But markets don't operate on ideals. They operate on timing, liquidity, and psychology. When external conditions shift, when policy changes accelerate, when uncertainty multiplies, when correlations break, the environment begins to demand something different. And this is where the tension emerges. The difference between what a culture encourages and what the market requires. Strong cultures can become vulnerable if they mistake consistency for correctness. There is a subtle but critical distinction between staying true to principles and staying rigid in execution. Principles should be durable. Execution must be flexible. Markets punish rigidity far more aggressively than they punish caution. The ability to pause, reassess, and recalibrate is not a failure of culture, it's a refinement of it. The real world has a way of exposing assumptions. Strategies that worked beautifully in one regime can underperform sharply in another. Valuations that felt justified under stable conditions can unravel when uncertainty enters the equation. Ignoring these signals in favor of maintaining appearances is costly. Markets don't reward loyalty to process alone. They reward alignment with current reality. Adaptation doesn't mean abandoning ambition. It means recognizing when ambition needs to change form. Sometimes progress isn't measured by expansion, but by preservation. Sometimes leadership isn't demonstrated by action, but by restraint. The hardest decision is often not what to pursue, but what to delay. This is especially true when narratives become dominant. Markets love stories. They simplify complexity and create comfort. But stories lag reality. By the time a narrative feels universally accepted, the risk is often already embedded in price. A culture that values independent thinking must be willing to challenge not only market narratives, but its own internal momentum. There is strength in admitting that conditions have shifted. There is credibility in acknowledging that the environment is asking for a different response. The most resilient institutions are not the ones that pretend change isn't happening. They're the ones that integrate change without losing their core identity. Ultimately, success in mark. TS comes from balance. A balance between confidence and caution, between culture and context, between the desire to act and the wisdom to wait. When culture serves the market, outcomes improve. When culture ignores the market, even the best intentions fall short. Adaptability isn't a weakness. It's a signal of maturity. And in markets defined by constant change, maturity is one of the most undervalued assets there is. Markets rarely reward extremes. They don't favor perpetual aggression, and they don't reward permanent caution either. The real advantage lies in balance, in understanding when to press forward and when to step back. Capital allocation is not a static decision. It's a living process that must respond to changing conditions with precision and discipline. Too often, investing is framed as a binary choice. You're either invested or you're not. That framing misses the point. The question isn't whether capital should be deployed, but how, when, and under what conditions. Every environment places a different price on risk. Ignoring that price doesn't make opportunity cheaper. It just makes mistakes more expensive. A balanced capital strategy recognizes that timing matters as much as insight. You can have the right idea at the wrong moment and still produce a poor outcome. When liquidity tightens, when volatility expands, and when uncertainty clouds valuation, forcing capital into the market can turn conviction into vulnerability. Balance means preserving the ability to wait without losing the ability to act. This approach requires patience, and patience is often misunderstood. It's not indecision, it's not hesitation. It's a deliberate choice to let information mature. Markets move faster than fundamentals in the short term, but fundamentals eventually assert themselves. A balanced strategy allows you to survive the noise so you can benefit from the sig. Now, balance also protects against overconfidence. Success has a way of reinforcing habits, even when conditions no longer support them. The danger isn't confidence, it's complacency. A thoughtful capital strategy constantly reassesses assumptions. It questions whether returns are being driven by skill or by environment, and it adjusts before the environment adjusts for you. Diversification, liquidity, and risk management aren't defensive tools. They're offensive capabilities when used correctly. They allow capital to be redeployed efficiently when opportunity reappears. They prevent forced selling. They turn volatility from a threat into a resource. That's the quiet power of balance. Importantly, balance doesn't mean dilution of conviction. When the moment is right, conviction should be applied decisively. But decisive action is most effective when it's supported by preparation. Capital that has been protected can be concentrated with confidence. Capital that has been exhausted has no such luxury. The goal isn't to avoid mistakes entirely. That's impossible. The goal is to avoid mistakes that compound. Balanced strategies accept short-term discomfort in exchange for long-term durability. They prioritize staying in the game over winning every round. In the end, markets reward those who respect complexity. They reward those who understand that discipline is not restrictive. It's empowering. A balanced capital strategy isn't about being conservative or aggressive. It's about being right at the right time. And over the long run, that balance is what turns opportunity into lasting success. So here's the real question, not what you owned, not what you traded, but whether you were prepared. Because markets don't reward noise. They reward patience with precision. They don't crown the loudest conviction. They favor the quiet discipline that survives long enough to. Oh, strike when the odds finally turn. Opportunity doesn't disappear. It waits. It waits for clarity. It waits for courage. And it waits for those who didn't exhaust their capital chasing certainty that never existed. Remember this. The most powerful move in the market is not action. It's control over emotion, control over timing, control over capital. And when the next real opportunity arrives, not the one everyone's talking about, but the one everyone missed, only those who stayed ready will have the freedom to act. That's how markets are won, not by rushing in, but by knowing exactly when to move.